The market doesn't care about your opinions, your convictions, or the stories you repeat to make yourself feel safe. It doesn't respond to hope, loyalty, or emotional attachment. The market responds only to reality. Prices move based on what is not what should be. The moment you truly understand this, your entire relationship with investing changes. You stop arguing with the market and start listening to it. Most investors don't lose because they lack intelligence. They lose because they fall in love with narratives. They read headlines that confirm what they already believe. They build stories around companies' economies or trends and then defend those stories as if their identity depends on them. But the market is ruthless toward ego. It exposes denial, punishes stubbornness, and rewards those who are honest enough to admit when they're wrong. Mastery begins when you replace stories with facts. Facts are numbers, earnings, balance sheets, interest rates, liquidity, and above all, price action. Price is the final vote of the market. It reflects all known information, all fear, all optimism, all uncertainty. When price disagrees with your opinion, price is right, always. Accepting that truth is not weakness, it's power. The most dangerous words in investing are, I believe. Belief without evidence is gambling disguised as confidence. Professionals don't believe, they assess. They observe what the market is doing, not what they want it to do. They ask hard questions. Is the trend intact? Is liquidity tightening or expanding? Is momentum confirming the story or quietly rejecting it? These questions keep you grounded in reality, where survival and success live. When the facts change, you must change immediately. Not tomorrow, not after the next headline, not after you feel better about it. The market moves faster than comfort. Delayed adaptation is the same as denial, and denial is expensive. There is no shame in changing your mind. The shame is in holding onto a losing position just to protect your ego. Ego is the silent killer of portfolios. It whispers that selling means failure, that adjusting means weakness, that admitting a mistake means you were never smart to begin with. None of that is true. The strongest investors detach their identity from their positions. They understand that being wrong is part of the process, but staying wrong is a choice. Reality-based investing creates calm. When you stop fighting the market, fear fades. You no longer need to predict the future perfectly. You only need to respond intelligently to what is happening now. This mindset turns uncertainty into information and volatility into feedback. The market is not personal. It's not cruel. It's not unfair. It's simply honest. And when you meet it with honesty of your own, facts over feelings, data over drama, adaptability over ego, you stop chasing mastery and start practicing it every single day. It being stubborn can feel powerful. It gives the illusion of confidence, of standing your ground when others doubt you. But in the market, stubbornness is often just fear wearing a mask. Flexibility, not rigidity, is what actually wins over time. The market is a living, moving system. And the moment you lock yourself into one view, you fall out of sync with reality. Many investors confuse conviction with refusal to adapt. They hold on to positions long after the environment has changed because they don't want to admit that the original conditions no longer exist. But the market doesn't reward loyalty, it rewards responsiveness. The greatest advantage an investor can have is the ability to pivot quickly when new information appears. That ability protects capital, preserves opportunity, and keeps you mentally sharp. Conditions change constantly. Interest rates shift. Liquidity expands and contracts. Sentiment turns from greed to fear without warning. A strategy that worked yesterday can become dangerous tomorrow. Flexibility means you are always reassessing. You're not married to an outcome, you're committed to the process. You ask, what is the market telling me now? Not, why isn't the market agreeing with me? True strength in investing isn't about holding on through pain just to prove a point. That kind of strength is empty. Real strength is letting go early, cleanly, and without emotional residue. It's recognizing that capital is a resource, not a trophy. You protect it so it can be deployed again when the odds improve. Walking away from a bad setup isn't quitting. It's resetting for a better one. The best investors don't try to be right all the time. They try to be aligned. Alignment with trend, with liquidity, with momentum, and with risk. When alignment breaks, they move. No drama, no attachment, just action. That decisiveness comes from clarity, and clarity comes from flexibility. Flexibility also keeps fear under control. When you know you can adapt, you don't panic when markets move against you. You're not trapped. You always have options. That freedom of movement creates confidence, not the false confidence of stubbornness, but the quiet confidence of preparedness. Holding on too long often comes from ego. Ego says selling means failure. Ego says changing direction makes you look weak. But the market doesn't care how you look. It only cares how you act. Every great long-term winner has a long list of trades they exited early, views they abandoned, and mistakes they cut without hesitation. That's not inconsistency, that's discipline. Flexibility is not chaos. It doesn't mean reacting to every tick or chasing every trend. It means staying open, alert, and willing to adjust when the weight of evidence shifts. You stay grounded, not frozen. In the end, mastering the market is not about endurance for endurance's sake. It's about intelligent movement. Knowing when to stay, when to scale, and when to step aside. Letting go with clarity is not loss, it's progress. It being stubborn can feel powerful. It gives the illusion of confidence of standing your ground when others doubt you. But in the market, stubbornness is often just fear wearing a mask. Flexibility, not rigidity, is what actually wins over time. The market is a living, moving system, and the moment you lock yourself into one view, you fall out of sync with reality. Many investors confuse conviction with refusal to adapt. They hold on to positions long after the environment has changed because they don't want to admit that the original conditions no longer exist. But the market doesn't reward loyalty, it rewards responsiveness. The greatest advantage an investor can have is the ability to pivot quickly when new information appears. That ability protects capital, preserves opportunity, and keeps you mentally sharp. Conditions change constantly. Interest rates shift. Liquidity expands and contracts. Sentiment turns from greed to fear without warning. A strategy that worked yesterday can become dangerous tomorrow. Flexibility means you are always reassessing. You're not married to an outcome, you're committed to the process. You ask, what is the market telling me now? Not, why isn't the market agreeing with me? True strength in investing isn't about holding on through pain just to prove a point. That kind of strength is empty. Real strength is letting go early, cleanly, and without emotional residue. It's recognizing that capital is a resource, not a trophy. You protect it so it can be deployed again when the odds improve. Walking away from a bad setup isn't quitting. It's resetting for a better one. The best investors don't try to be right all the time. They try to be aligned. Alignment with trend, with liquidity, with momentum, and with risk. When alignment breaks, they move. No drama, no attachment, just action. That decisiveness comes from clarity, and clarity comes from flexibility. Flexibility also keeps fear under control. When you know you can adapt, you don't panic when markets move against you. You're not trapped. You always have options. That freedom of movement creates confidence, not the false confidence of stubbornness, but the quiet confidence of preparedness. Holding on too long often comes from ego. Ego says selling means failure. Ego says changing direction makes you look weak. But the market doesn't care how you look, it only cares how you act. Every great long-term winner has a long list of trades they exited early, views they abandoned, and mistakes they cut without hesitation. That's not inconsistency, that's discipline. Flexibility is not chaos. It doesn't mean reacting to every tick or chasing every trend. It means staying open, alert, and willing to adjust when the weight of evidence shifts. You stay grounded, not frozen. In the end, mastering the market is not about endurance for endurance's sake. It's about intelligent movement. Knowing when to stay, when to scale, and when to step aside. Letting go with clarity is not loss, it's progress. Not every idea is meant to be a big bet. One of the most common mistakes in investing is treating all opportunities as equal, committing the same level of capital and emotion to every trade or investment. True discipline begins with understanding that selectivity is a strength. Capital is finite, and how you allocate it matters more than how many ideas you generate. The market doesn't reward enthusiasm, it rewards precision. High-level investors think in probabilities, not possibilities. An idea can sound compelling, even logical, and still be poorly timed or unsupported by data. Discipline means waiting for alignment when the odds, the evidence, and the environment all point in the same direction. That alignment doesn't happen often, and that's the point. You don't need many big wins. You need a few well-timed, high-conviction decisions executed with clarity. When conviction is high, hesitation is costly. Decisiveness matters. If the data is strong, the trend is supportive, the risk is defined, and the timing is right, then half measures dilute results. This is when you lean in not emotionally, but methodically. You size your position in proportion to your confidence, understanding both the upside and the downside. This isn't recklessness. It's earned aggression. But discipline is even more visible when conviction is low. Knowing when not to bet big is what protects you from long-term damage. If the signals are mixed, if uncertainty is high, or if risk cannot be clearly measured, the correct move is restraint. Protecting capital is not pessimism. It's respect for uncertainty. You don't force trades just to feel productive. Survival always comes before growth. This is the rule that separates professionals from amateurs. You can't compound returns if you're constantly recovering from large losses. Every unnecessary drawdown steals time, confidence, and opportunity. By managing position size and exposure, you stay in the game long enough for probability to work in your favor. There is also a mental discipline in this approach. When you stop overcommitting, you stop overreacting. Smaller positions during uncertain times keep your emotions in check. You think more clearly, make better adjustments, and avoid the spiral of fear and hope that ruins decision-making. Emotional stability is a competitive advantage. Great investors understand that patience is part of conviction. Waiting for the right moment to deploy capital is as important as the deployment itself. They don't chase every move or respond to every headline. They wait for the setup that justifies commitment. In the end, mastery isn't about being bold all the time. It's about knowing when boldness is warranted and when caution is strength. By betting big only when conditions align and protecting capital when they don't, you build a process that survives volatility and thrives over time. Winning in the market is often misunderstood. Many people believe success means being right all the time, avoiding losses completely, or finding a strategy that never fails. That belief is not only unrealistic, it's dangerous. Losses are not a sign of weakness in investing. They are a natural cost of participation. The difference between those who last and those who disappear is not whether they lose, but how they manage those losses. Risk is the only thing you can truly control. You can't control the market, the news, interest rates, or unexpected events. You can't force prices to move in your favor, but you can control how much you're willing to lose, how you size your positions, and how quickly you respond when a trade proves you wrong. This focus on risk turns investing from emotional guessing into a disciplined process. Cutting losses fast is one of the hardest skills to master because it goes directly against human instinct. The natural reaction is to wait, to hope, to give the position just a little more time. Hope feels comforting, but it's expensive. Small losses are manageable, large losses are destructive. Every time you delay accepting reality, you give the loss more power over your portfolio and your mindset. Protecting the downside is not pessimism, it's professionalism. When you define your risk before entering a position, you remove surprise from the equation, you know what you're willing to lose, and if that level is reached, the decision is already made. There's no debate, no emotion, no negotiation with yourself. This discipline preserves both capital and mental energy. Staying in the game is everything. Investing is not about one trade, 1 year, or one cycle. It's a long-term process where probability only works if you survive long enough to let it play out. One uncontrolled loss can erase years of progress. That's why the best investors think defensively first. They build portfolios designed to withstand mistakes, not just reward success. Loss control also creates clarity. When you know your downside is limited, you think more clearly. You're not paralyzed by fear or consumed by stress. You can evaluate opportunities objectively, adjust when needed, and move forward without emotional baggage. This mental freedom improves decision-making across the board. There's also humility in risk management. It's an acknowledgement that you don't know the future with certainty. Instead of pretending otherwise, you prepare for being wrong. That preparation is what allows you to act confidently. True confidence doesn't come from prediction. It comes from protection. Over time, consistent risk control compounds into resilience. You avoid catastrophic setbacks, recover faster from losses, and maintain the confidence to keep acting when others retreat. That resilience is what separates long-term winners from short-term participants. In the end, winning is not about perfection, it's about discipline. By cutting losses quickly, protecting the downside, and respecting risk above all else, you give yourself the greatest advantage of all, the ability to stay in the game long enough to win. Volatility is often portrayed as something to avoid, a sign that danger is near and safety has disappeared. But in reality, volatility is not the enemy of the investor, it is the price of admission. Without volatility, there would be no opportunity, no mispricing, and no edge. Smooth markets feel comfortable, but they rarely offer value. It's the uncomfortable moments that separate disciplined investors from emotional participants. Fear is the force that creates opportunity. When markets swing violently, it's not because fundamentals change overnight, but because human emotions take control. Panic exaggerates risk and greed exaggerates reward. Prices move too far, too fast in both directions. This emotional overaction is where mispricing is born. The investor who understands this doesn't run from volatility, they study it. When others panic, the natural instinct is to panic with them. Headlines scream urgency, prices fall rapidly, and uncertainty feels overwhelming. But this is precisely when analysis matters most. Calm investors slow down when the world speeds up. They examine balance sheets, assess liquidity, and evaluate whether price declines reflect reality or emotion. They don't confuse movement with meaning. On the other side, when markets are surging and everyone is chasing returns, discipline becomes just as important. Euphoria is as dangerous as fear. Rising prices create overconfidence, and overconfidence leads to reckless behavior. Disciplined investors resist the urge to chase momentum without justification. They ask whether valuations still make sense, whether risk is being ignored, and whether optimism has replaced logic. A calm mind is a competitive advantage. Emotional reactions feel urgent, but they're rarely intelligent. By maintaining emotional distance, you gain clarity. You see what others miss because they're too busy reacting. You recognize that volatility doesn't demand immediate action. It demands thoughtful response. Volatility also reveals character. It exposes weak strategies and fragile convictions. Investors who rely on hope or leverage are forced out when conditions tighten. Those who respect risk and remain flexible are left standing. Over time, this natural selection benefits disciplined participants. There's also a rhythm to volatility. Markets don't move randomly, they swim between fear and greed. Understanding this cycle allows you to position yourself ahead of the crowd. You don't need to time every move perfectly. You only need to avoid emotional extremes. Buy when fear has distorted price, and be cautious when optimism has erased margin of safety. Calm doesn't mean inactive. It means deliberate. When opportunity appears, calm investors act decisively because they've prepared in advance. They know what they're looking for and what they're willing to risk. Preparation turns volatility from threat into tool. In the end, chaos is not something to fear. It's something to respect. Emotions create the noise, but discipline finds the signal. By staying analytical in panic and disciplined in euphoria, you position yourself where value lives. That's where real opportunity begins. Mistakes are not a flaw in investing. They are a requirement. Anyone who participates in the market long enough will be wrong, often and sometimes painfully. The illusion of perfection is one of the fastest paths to failure because it prevents learning. What separates long-term winners from everyone else is not the absence of mistakes, but the speed and honesty with which they deal with them. Failing quickly is a form of discipline. It means recognizing early when reality no longer supports your decision and responding without delay. The longer you hold on a mistake, the more expensive it becomes, both financially and emotionally. Small errors can be corrected. Large, ignored errors become scars that linger for years. Speed matters. Not speed of action, but speed of acceptance. Learning aggressively requires humility. It means asking hard questions after a loss instead of making excuses. Was the thesis flawed, or was the timing wrong? Did you ignore a risk signal because it's inconvenient? Did emotion override discipline? Every loss contains information, but only if you're willing to examine it honestly. Avoiding this reflection doesn't protect your confidence, it weakens it. Emotional baggage is what turns a single mistake into a pattern. When you carry frustration, anger, or shame from one trade into the next, you distort your judgment. You start trading to recover, to prove something, or to erase pain. That mindset leads to impulsive decisions and unnecessary risk. Letting go emotionally is not forgetting. It's clearing space for clarity. Every loss is tuition. You are paying for experience, insight, and growth. Some lessons are inexpensive, others cost more, but all of them have value if you learn from them. The mistake isn't losing money, the mistake is losing the lesson. Investors who refuse to learn end up paying the same tuition again and again, often at a higher price. Moving on without emotional weight restores balance. Once a loss is accepted and understood, it no longer controls you. You regain objectivity. You can evaluate new opportunities based on merit, not on the desire to fix the past. This reset is essential for consistency and long-term performance. There is also strength in self-forgiveness. Markets are complex, unpredictable, and constantly changing. Expecting yourself to be right all the time is unrealistic and unfair. By allowing room for error, you create a healthier relationship with risk. You become more willing to act, adjust, and improve. Over time, this approach compounds into wisdom. You recognize patterns faster. You avoid repeating the same mistakes. Your confidence becomes grounded, not fragile. You trust your process because it has been tested, refined, and stress tested through failure. The lesson only hurts if you refuse to learn it. When you accept mistakes as part of the path, they lose their power to define you. Instead, they become stepping stones toward mastery, clarity, and long-term success. True confidence doesn't announce itself. It doesn't need validation, applause, or constant reassurance. It's quiet, steady, and deeply rooted in preparation. In the market, loud confidence often masks insecurity, while quiet confidence reflects understanding. It comes from knowing you've done the work, examined the details, and respected the risks long before you ever place a trade. Preparation is where confidence is earned. It's built through research, scenario analysis, and honest assessment of what could go wrong. When you've tested your assumptions instead of falling in love with them, you remove surprise from the process. You know why you're entering a position, what would make you wrong, and how much you're willing to lose. That clarity is calming. It replaces hope with intention. Respecting risk is a critical part of this confidence. When you acknowledge uncertainty and plan for it, fear loses its grip. You're not pretending to know the future. You're preparing for multiple outcomes. This mindset allows you to act decisively because your confidence is not tied to being right, but to being prepared. Even if the outcome isn't perfect, the process remains solid. Quiet confidence also allows you to stand alone. Markets often reward those who are willing to act before the crowd or against it, but that requires emotional independence. When you've done your own work, you don't need consensus to move forward. You're not swayed by headlines, social media, or groupthink. You trust your process, not the noise. This independence doesn't come from arrogance. It comes from repetition and experience. You've seen cycles before. You've watched emotions distort prices. You've learned what matters and what doesn't. That experience tempers reaction and sharpens judgment. You don't rush, but you don't hesitate either. Decisive action is the natural outcome of preparation. When the moment arrives, there's no internal debate, no second guessing. You act because you're ready. And if conditions change, you're equally ready to adjust. Confidence doesn't mean stubbornness, it means clarity. There's also humility in true confidence. You understand that mastery is a process, not a destination. You remain open to learning, adapting, and improving. This humility keeps you grounded and prevents complacency. It reminds you that preparation is ongoing, not a one-time effort. Over time, this quiet confidence compounds. You make fewer emotional decisions. You recover faster from mistakes. You remain calm during volatility. Others may mistake this calm for passivity, but it's the opposite. It's controlled readiness. That's how mastery is built. Not through noise or bravado, but through consistent preparation, respect for risk, and the courage to act decisively when the time is right, even if you're standing alone.